Street.com, Active Trader Magazine. Ladies and gentlemen, here to present what our current option indicators are saying about the market. It is always an honor to introduce Mr. Lawrence McMillan of McMillan Analysis Corporation. Welcome back to Traders Corner, Larry.
Yeah, thanks, Rob. You see the screen all right?
Loud and clear. I got your splash screen.
Okay. All right, everyone, we're going to take a look at what our indicators are saying about the market, and it's pretty interesting. Well, the market's always interesting, but we're seeing right now that most of the indicators are bullish, but price is not cooperating. So price is always king. So we'll address that as we get to it. Just a little background. I started this company back in 1990 as a derivatives research company. We were doing data analysis, publishing newsletters, etc. Then after some success with recommendations to clients surrounding the 2008 financial crisis, we moved into money management. And then we also do a certain amount of option education. We have a mentoring division, and of course we do webinars such as this. I'll come back to this later, but there is a URL set up on our website, optionstrategist.com /Traders Corner, and that's a where you can take a look at some of the specials that we're offering with the respect to today's webinar. I'll come back to that later. So the main four things that we look at when we're talking about the market is, number one, the chart of the S&P 500, because it's sort of the case now. The chart's not exactly confirming what the indicators are saying, and so price is always king. So you have to be a little bit careful in that situation. We'll also take a look at equity-only put-call ratios, market breadth, or we have a sort of an option twist on things, and then the various volatility indicators surrounding VIX. So I have a couple of important rules that basically overrule everything. And the first is oversold does not mean buy. So we've been oversold many times in the last year, and the market's just continued on down. So we want to be careful about what an oversold condition. We don't want to jump in there until it actually becomes a confirmed buy signal. Then the companion to that is overbought does not mean sell either. So right now we are seeing some overbought conditions, but they're not confirmed sell signals yet. So we would not act on those in a negative fashion. Here's the long-term 2-year S&P chart. The main thing on this, of course, is the large, thick blue lines there, which are the downtrend lines of this bear market. And you can see that we're approaching the downtrend line right now. It's very close to, well, exactly, we're pretty much right on it. So I'm watching, but it has so far, every time it's come up there, it's rejected the moves and the market's gone lower. This time it seems like it's trying a little bit harder, but we'll see. This year we had first a 24% sell-off, and then later in October it extended itself to a 27% sell-off. So that's the first time we've seen that kind of move since 2020. And in 2020, of course, it was just pandemic related, and it was like a 1-month bear market. This is much more serious, and we'll talk about later whether you can even if we do break through the downtrend line, will that really end the bear market? This is a 1-year chart. I just usually throw this in here. We can take a look at what's the near-term support and resistance levels here. First of all, there's the downtrend line, the resistance line here. We've reached 4,100 twice in late November, early December. We're unable to get through, and in my opinion, we're going to have to break through that before I would really say the S&P chart has turned bullish, even though it might have exceeded the downtrend line just slightly. On the downside, we have support down here. Well, that's 3760, but this whole area in here was support in late December, so that should hold back any declines that might develop here. And we're really looking for is the market to break out of that trading range. It's a wide trading range, over 300 points wide, so you can trade within it, but you're not going to get a sustained move, obviously, until you can break out of there. So just to quickly summarize, the chart of S&P has been bearish since a year ago, and it still is bearish as long as that downtrend line is in there. I'm requiring a close above 4,100 to turn the chart positive. And of course, I said there's support at 3760. We're running right now into the 200-day moving average as well. It's declining. We've closed above it on a couple of days, but we also closed above it last March a couple of days, and that didn't really help a lot. So one thing about a bear market, you have these oversold rallies. And just backing up, all those green numbers there are the size of oversold SPX rallies that took place, but they all ran into the downtrend line and eventually failed after that. So we're still maintaining a core bearish position, but we are trading other signals around it. That's what we tend to do in our daily and weekly newsletters. Another thing that we look at is modified Bollinger Bands. When John Bollinger invented Bollinger Bands, he defined volatility as the standard deviation of closing prices, which sounds correct. But the math people, Black and Scholes, and the mathematicians tend to use a different definition, which is the standard deviation of daily percentage price changes. So it gives you a slight modification to the Bollinger Bands, and that's what we use. So we look for the market to break out above the upper band or below the lower band, and then return inside to get a signal. So this is the one-year chart again with the Bollinger Band, modified Bollinger Bands drawn on the chart. So for example, let's take the sell signal in the middle here. This is the +4 standard deviation band, and the one just inside it is the 3 standard deviation. So you see we moved outside the 4 standard deviation here and then back inside there. So that was the sell signal. And we look for the market to move to the opposite band to cover, or in this case, cover the short. Then we had these various Bs. The red Bs are successful buy signals. This one came at the bottom. This one was not too successful. It started out okay, but then quickly collapsed and got itself stopped out here. And then this one set up and ran for a couple of months. We basically taken off all our positions that we had in line with that buy signal. So we're just waiting for a new modified Bollinger Band buy signal. We call them McMillan volatility band signals because we have some further conditions that we place on those. I'm not going to go into those right now, but we are just waiting at this point for the market to break out above the upper band or below the lower band to set up the next signal. We do the same analysis on all stocks, indices, ETFs, and futures. So if you're interested in receiving that information daily, the signals that is, from us, we do have a subscription service set up for that. Just visit our website and look for volatility band subscription. So let's move on to put-call ratios. Put-call ratios are contrary indicators. And for predicting the broad stock market, we use the equity-only put-call ratio. That is all stock options that trade. So the theory was identified by Marty Zweig back in the 1950s. And as I said, it's a contrary theory. So if too many people are buying puts, then we want to do something bullish. If too many people are buying calls, then we want to do something bearish. The trick is deciding what's too much put buying or too much call buying. So the standard put-call ratio would be something like this. Let's say at the end of the day, we sum up the volume of all the puts that traded, let's say on IBM. Then we sum up the volume of all the calls in IBM. We divide the two. That's the put-call ratio. So since puts are in the numerator of the fraction, heavy put buying will make the ratio go higher, but when is there likely to be heavy put buying? Well, it's when the stock is going lower. So we get an inverse relationship between the stock price and the put call ratio. And the signals come at a local maximum and local minimum. So let's say the stock is declining here, And as the stock is declining, traders are buying puts, the public is buying puts, and so everybody's right for a while. Eventually, the put buying exhausts itself, and we get a local maximum in the put-call ratio. That is a buy signal for the underlying stock. Then the stock starts to move up. As it's moving up, over to the left here, people are buying calls. That forces the ratio lower. Eventually, the call buyers get satisfied, and we get a local minimum on the put call ratio chart, and that is a sell signal for the stock. So that's how we interpret these charts. We post over 1,600 charts on our website every day, put call ratio charts, that is, and that's a fairly inexpensive data service that we have. It's called the Strategy Zone. Anyway, this is not a current chart, but on top is the S&P 500 index, and on the bottom is the equity-only put-call ratio. And you can see the inverse symmetry that exists most of the time, and that's why we use that ratio to predict the broad stock market. So here's the standard ratio. This is just the volume of puts and the volume of calls. And you can see that we most recently had a local maximum on the chart here in late December, and so that's a buy signal. And so this is now in effect. It took a little while for it to kind of build up some momentum, but now it's strong, and it will come down here and eventually make a local minimum someday, and that will be the next sell signal. But right now it's on a buy signal from a very high level. These are the highest levels of this put call ratio that we've seen since April of 2020, and they're trading for around 85. 85 means that 85 puts are trading for every 100 calls, which is quite a lot in terms of stock options. Index options, that wouldn't be a lot, but stock options, it is. And so you can see that there were a good number of sell signals over the past year, and also intermediate buy signals. So this has a good track record, and we follow it pretty closely. Now, as computers have come along, we've been able to calculate another put call ratio, the dollar weighted or weighted put call ratio. And this one, we're going to use the options price. At the end of the day, we take the closing price, multiply it by the volume that traded that day, and get an estimate of the dollar volume of that option for the day. Now, we could do that on a tick-by-tick basis, but that's an expensive data set, and it really wasn't giving us any better signals than using it this way. So let's say we do that for every option on IBM. Then we sum those multipliers up for all the puts, separately sum them up for all the calls, divide the two, and now we have the dollar weighted put call ratio. And what we're doing now is measuring the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion. And this is actually a much better, it gives the signals in the same place, but they're usually much crisper signals. So you can see, again, this one had a buy signal here in the end of December where we had your local maximum, so that's a buy signal. The previous sell signal had come in early December. Usually the market doesn't go down in December, but it did this year, and fortunately it wasn't as bad as it was in 2018. But again, these are very high levels, the highest we've seen since the pandemic crash or thing. And so these were extremely oversold conditions that had rolled over to buy signals, and now this is advancing, or declining, I guess, rapidly, and somewhere down here we'll set up a new sell signal. But right now those are very bullish. We also have had a put call ratio buy signal from the total put call ratio. That's all stock and index options, not futures options, but just stock and index options that trade. So that's been a reliable indicator as well, and that put call ratio just rolled over to a buy signal a few days ago. So basically, these are all on buy signals right now, and that's a strong internal market indication. What do we buy when we have these signals, whether we have a modified Bollinger Band signal or put call ratio signal? Well, I tend to buy an option with a fairly high delta. So the delta of a call ranges between 0 and 1. If you buy a call with a delta of 0, the stock will move up and the call won't move at all. So I don't like that. I'm in the business of predicting the underlying, and I want the call to follow along. So I want a higher call delta. Basically, we're buying slightly in the money calls with a delta of 0.7 or higher. If we're going out farther in time where options are more expensive, we might buy an at the money call. But even there, the delta is going to be slightly above a half. So essentially, as the stock moves up, these deltas increase, and also my option value will increase. And so if I'm right on the stock, I'll be right on the option. A lot of times you see, especially on TV, everyone is spreading the options. You should not really be doing bull spreads or bear spreads on the options unless the options are expensive. So in a bull spread, you buy the call at the lower strike and you sell a call up here at this higher strike. And so it limits your profit potential beyond this point in time. So to limit your profit potential, you really want to be sure you're doing the right thing. So the only really right time to do that is when the options are expensive. We have a large set of data on our website that tells you how expensive options are, and that's updated for free every Saturday. So you can always take a look at that to get an idea of what percentile between 0 and 100 how expensive the options are. Now, if you were just to buy a call, that would be this red line in this chart, and you can see the spread is the black line. What the problem is with the black line, with the spread, you give away everything above there, and if you're really right on the underlying, of course, it's going to go roaring up through there. Now, proponents of the spread strategy will always say things like, and I'm talking here not when the options are expensive, but just all the time, as they seem to be on TV. They'll say, well, you're risking less. You are not risking less. You're risking 100% of your investment, whether it's a bull spread or a call. Now, dollars, yes, a few less dollars. So you can adjust that for yourself by just buying a few less calls than you would have bought bull spreads. But essentially, you're risking 100% in both cases. So it's a fallacy to say you're risking less. You can mitigate the negative effects of a bull spread too by widening the strikes out. So one of the places that we are using spreads is in SPY because VIX is still pretty high. So in a call spread in VIX, we'll make the two strikes about 15 to 20 points apart. And in a put spread, because puts are more expensive on a relative basis in SPY, we'll widen them out 30 to 50. And in addition to that, if you're right and the stock, let's say you're in a call bull spread, the stock moves up to your short strike, you can roll the spread. Here's an example. Suppose S&P is at 397 to begin with, and you buy a 397 call and sell a call 15 points out of the money. So that's a bull spread. Now, you're fortunate enough that the stock rolls right up and hit the high strike. But of course, from then on, you've cut off your profit potential. So sell the spread you did own and buy a new one with higher strikes. So this is not as good as just owning a call, but it's better than just sitting there and letting the bear spread, the bull spread just cap out and not provide you any further profits above that level. I'm just going to show you a couple of put call ratio charts that we've been looking at lately. This is one NRG Energy, and you can see the put call ratio formed a local maximum here just last week. The stock had been bouncing around in a trading range, so we wanted to see it close above 33 here before we actually bought the calls, and it did that yesterday, I believe. The chart's not quite up to date, just edged above there yesterday. And so we bought calls on energy, and so we will be following those now in our newsletters, the Option Strategist newsletter anyways, going forward. You see the last buy signal here was a decent one. The stock did rally, it didn't rally a long time, but it did rally. And then local minimums down here. By the way, on the stock charts, not the S&P chart like we looked at earlier, we only use the extreme levels for the buys and the sells. We don't use these intermediate term or intermediate chart local maximum and minimums. This is a thing that's been going on recently. I don't know if you've been paying attention. We wrote an article about it in the Option Strategist newsletter a couple of issues ago. There's a form of arbitrage that's taking place right now when stocks, especially very liquid stocks, have deeply in the money options, which they do after put options after the market's gone down for a while. There's a form of arbitrage that is taking place right now, and it's completely distorting the put volume in certain cases. This is one, Google. You can see the Google options used to trade, Google put call ratio used to be down in, this range, going between, let's say, 100 and 200. Now, this is a weighted ratio, so 200 means $200 is being spent on puts for every $100 being spent on calls. You can see now the ratio has gone all the way up here, but that's because of these put spreads, which are not reflecting speculative activity. They're just reflecting arbitrage activity. So that's something you need to take into account if you're looking at these individuals liquid stocks that have gone down a lot. We can also do the put call ratios on futures options. So the bottom chart there is crude oil options that trade on the COMEX, and they're the same thing, put call ratio, whatever. So we just recently got a buy signal from the put call ratio in here. Now the local maximum is a put call ratio, but you could trade, of course, the crude oil futures options that trade on the COMEX, but in many cases there's a companion ETF on the stock side of the fence, and so you could trade USO options. The USO mirrors the price of crude oil futures or crude oil, and so you could buy calls on USO, which we are looking to do, but only if it can break out above this trend line right here, this resistance line, which it has not done yet. But it's still a valid buy signal, and so we might get that breakout fairly soon. So moving on to the next topic is breadth of the market. That's advances minus declines. So you can do a couple of things with breadth. One is you can keep a cumulative total, but probably more importantly, you can keep an oscillator. So our oscillator definition is the oscillator value of today is 90% of yesterday's oscillator value plus 10% of the difference between today's advances minus declines. Now, one readily available set of advanced decline data is the New York Stock Exchange data, which is published many places, but there are things in there that are not stocks. So we looked for a stocks only data set, and it turns out we had one, right under our nose. That's all stocks that have listed options on them. This in our database, very easily to access, large caps, small caps, NASDAQ, NYSE, a lot of different variety. And so that's what we use most of the time. So here's the oscillator itself going back to, 2013. And it's the green area is oversold. And you see the market didn't go down very much over those years until last year. So we didn't have much in the way of green area. We did have a big sell-off in December 2018, and of course, then the pandemic. Interestingly enough, we got almost to that same level last summer. So very oversold, but by what I said earlier, oversold does not mean buy. So we don't buy until it stops being oversold. In this case, we had a buy signal on December 29th. And now the oscillator is way up here in very overbought territory. It's bouncing around up here, but that's okay. Again, overbought does not mean sell. We won't sell until it stops being overbought. And so right now, for example, a day like yesterday, market was down 60 S&P points and then back up again 60 S&P points. Usually on a day like that, when it starts out to the downside, you'd have negative breadth, but in fact, breadth was positive yesterday. So breadth right now is one of the strongest, most positive indicators in the entire market. And of course, we have this buy signal based on this stocks only oscillator. So again, we're paying attention to that, of course. These are very, I would say, flighty signals and breadth that can whipsaw back and forth, but it has a good track record. And right now, as I said, it's a very strong internal indicator. Here's another one we follow, new highs versus new lows. These are New York Stock Exchange data only. And we got a sell signal last April that lasted all the way till last week. Finally, last week, we had enough positive movement to get over 100 new highs at least 2 days in a row, and they outnumbered the no new lows on those 2 days, and so that is a buy signal. So this indicator just recently moved to a buy signal, and it will stay there until new lows outnumber new highs for at least 2 consecutive days. So all of these internal indicators are bullish right now. Let's see what volatility is telling us. When we look at the chart of VIX, spike peaks are important. Those are buy signals, but the trend of VIX is also very important as well. It should be trending opposite to the way the stock market is going. So then there's a companion to that, is that a low VIX is overbought, but again, overbought does not mean sell. Right now, VIX is pretty low compared to where it's been. So you can see, first of all, just in that regard, VIX is trading at essentially the lows of the last year. And every time it's gotten down to this level in the last year, the market's gone down, VIX has gone up, and it's been a sell signal. It's kind of hovering in here. In fact, even if the market goes up from here, I don't expect VIX to go down a lot. There's still a lot of worried traders out there buying SPX puts. SPX puts tend to dictate the price of VIX. So the spike peak buy signals are another thing I mentioned on this chart. The red letters are successful signals, the blue letters are not. We had a very strong signal in October, and we got about a 2-month ride out of that one. But then we had a failed signal here in December, and right now we have no signal at all from the spike peaks indicator. The signals, we have a trading system we built around those, and they only last for a month. So there hasn't been any activity in a month. Now, the last thing I mentioned was the trend of VIX. So right now, this is the 20-day moving average, and this is the 200-day moving average. And so the 20-day is below the 200-day, and VIX itself is also below the 200-day. When that is the case, we say the trend of VIX is down, and that's bullish for stocks. So right now, that's going to be in place for a while, because VIX would have to rise up there above the 200-day, which is roughly at 25.50, in order to negate the trend, which is bullish. It's a downtrend in VIX, but that's bullish for stocks. So just that sort of recaps that. I guess the question you have to ask yourself, that's mostly bullish, but is VIX really too low now? And it used to be when the market was in a bullish mode, VIX would go down to 14, 12, even 10, but that's not happening in a bear market. So this might be about as low as it's going to go. But in any case, it's still worth paying attention to the VIX indicators. Now, you can't trade VIX, but you can trade the VIX futures. So there's a couple of things you should understand about the VIX futures. I call this the construct. But in a bullish market, the futures term structure slopes upwards. In a bear market, the futures term structure slopes downwards. So we pay attention to that. Here's the prices of last night's close. The front month is February. VIX closed at 1908. The February's closed at 2005, so subtract the two. That's a 97-cent premium on the Feb futures. And you can see each futures contract here is trading a little bit higher than its predecessor. So the term structure is sloping upwards. So with the term structure sloping upwards, and they're all trading at premiums to VIX, that's a bullish picture. That's a bullish picture. So, we definitely would classify this as a positive factor. Now, if you're not looking at VIX futures prices, you can look at the CBOE volatility indices that it publishes daily, or continuously, really. So the VIX is a 30-day measure. They also publish a 9-day measure, a 6-month, or 3 month, a 6 month, and a 1 year. You can see that these are all sloping upwards. But what is this thing doing? It's very high right now. It's higher really than both of these. That's because we've got the Fed meeting coming up in the next 9 days. And so traders are worried about what that might say. And so prices of short-term options are expensive because of that, and that's what this is reflecting. So I'm going to call this mostly bullish because of that one outlying thing there. But in the past few months, this has been happening all the time, and it hasn't really been any severe cause for the market. So the one thing we do really watch very closely is the relationship between the two front month futures. February closed at 2005 last night, March at 2108. That's a bullish construct. If they invert by $1 or more, that would be very negative. We had a lot of negative inversion back in March of 2020, and the market was collapsing. In this bear market of the last year, we haven't had a crash really. We've just been slowly grinding to the downside with a lot of intermittent rallies, and so the construct has not been nearly as bearish as it has been in past market declines. I want to mention a thing that's beginning tomorrow. We call it the January seasonal trade, and we have various seasonal patterns we follow throughout the year, but this one is buy the market at the close of trading on the 18th trading day of January and hold for 4 days. So this year, the 18th trading day is tomorrow, the 27th. So we will be buying spider bull spreads because, again, VIX is still pretty high, so we're using a spread there and holding them for 4 days. The reason, you don't necessarily need a reason why a seasonal trade works, but the reason behind this is basically at the beginning of the year, institutions receive cash inflow from new investors or for people, adding money to their accounts. And so they put a lot of that to work right away. So that's that indicator that measures what the market is doing in the first 5 trading days of the year. This year that was up, and that's a bullish year-long factor. But then at the end of the month, they still have some of that cash left, and they put it to work then because they don't want to show cash on their balance sheets. So that's basically the reasoning behind it. In the last 37 years, and the reason it's 37 because that's when I started trading it, so I'm just using those actual data points. We've had 29 wins and 8 losses on average, including the losing years. S&P advances about 1.1%, or roughly current levels of about 44 points. So 44 points is, we can move that in a day. Nowadays, that's not really a big deal, but still worth trading. So we will be trading that indicator beginning tomorrow night. So let's just summarize where we stand here. All those things on the left were bullish. New highs, new lows, that was a new buy signal. Breadth oscillators, buy signal, very overbought. Trend of VIX is down, that's bullish for stocks. The equity-only put-call ratios are bullish. They recently made local maximums on their charts. The construct of volatility derivatives is positive, and the seasonal bullish factor comes in tomorrow night. So why are we just jumping in here and buying everything we possibly can? Well, there's just one thing over here, and that is the chart of S&P. And in my opinion, you don't want to really be buying really heavily right at the top of the range. Wait for the breakout. So over 4,100, yes, we would then really be acting strongly. We are long some based on these indicators on the left side of the page here. But as I mentioned at the very beginning, you really don't want to be fighting the chart of S&P. It's not maybe as bad as fighting the Fed, but it's fighting the market. And so you'd rather be in tune with the market. So hopefully all of these indicators there will line up to push the market through 4,100 resistance level, and then everything will be in agreement. We can move that to the left side. But for right now, that hasn't taken place yet. So we are still maintaining an out-of-the-money core bearish position and trading these other signals around that. So I said I was going to come back to the offers that we have here. If you go to optionstrategist.com/traders corner, first of all, you can download the PDF of this webinar, both in color and grayscale. And so that should be useful to you. And then we're offering our home study course for a very low price of $199. That's 14 seminars. Each one is about an hour and a half to 2 hours in length. And it starts with the beginner stuff, but moves into the advanced things by the end of the 14 seminars. Also, our 3 best newsletters, our daily volume alerts, the daily option strategist and the option strategist newsletter. You can buy 1 month of all 3 of those for a total of $99. And you don't have to take them all at once because that'd be like overwhelming you, too much information. So you can take them consecutively rather than concurrently. Just a quick mention of the option strategist. Oops, so we're really actually now in our 32nd year of publication. Change that. And the full track record is available on our website on a year-by-year basis. The daily strategist is really the same sort of thing, but on a daily basis and a little more aggressive, I would say, in many cases. Also, track record available on the website. And then daily volume alerts, I write this one myself. Originally, we were going to use option volume to spot takeovers. It works some of the time, but it works so infrequently that you really need to do other things. And so all of these newsletters incorporate all of the trading systems that I've been talking about today. And of course, the 2 daily newsletters incorporate them on a much more timely basis. So the track record is available of that as well, of daily volume alerts. We also have a YouTube channel. I invite you to subscribe to our YouTube channel. I put up a market comment every Monday morning. And we have a couple of other newsletters as well. One following special situations, and another one where we look for out of the money, relatively conservative naked put writing situations for those who it would be what in the old days used to be covered call writing accounts, but it's much more efficient to sell naked puts than to do covered calls. So I want to just finish up with this chart. So 1973-74 bear market, I actually traded that market. That was my first serious trading. And the market made a new all-time high this is the Dow in this chart, by the way. It made a new all-time high in early 1973, just as we made a new all-time high last year. It surprised many people that it then launched into a bear market. And you can see there's some strong rallies here bouncing around, but it was definitely a bear market. Tried to poke out above that trend line once, came back down, then finally did break out and went to the upside. And at that time, many people thought the bear market was over, and a lot of bears got hurt. There's an old saying that everybody loses money in a bear market. The bulls refuse to sell. They keep thinking the market's going to come back, and the bears get too aggressive and get wiped out on these big rallies. Well, anyway, back then the oil embargo came along, sent the thing lower. Then we bounced around for a few months, the oil embargo, and it's still bouncing around. But there was what they called at that time the 3 I's were a problem for the market: inflation, interest rates, and impeachment. Well, right now we have inflation and interest rates. I don't think impeachment's on the table. But in any case, the market was struggled because of that overlying problem. And I know right now all the bulls keep saying inflation is peaking, it's going to go away, not be a problem. Well, that's what they said back then too. Meanwhile, Nixon eventually resigned, and that sent the market spiraling to the lows in October of that year. Surprisingly, Gerald Ford came out, he was president by then. Gerald Ford came out with this Whip Inflation Now campaign. I get passed out these buttons, win buttons. It's sort of odd that it actually seemed to work as far as bottoming the market. It didn't work as far as whipping inflation. That was a problem for about another 9 years to come. But the market did eventually bottom in October of 74. So that would basically say this, if we follow a similar pattern, this market won't bottom until October of this year, 2023. I know that's not a real popular opinion, but or even a common opinion, but it does look like it might work out that way. And so where are we right now? If we just look at this market, we're about right there. It seems like we're pressing up against the downtrend line and maybe about ready to break out through it if these internal indicators that I'm showing you are so bullish. But that doesn't guarantee that the bear market won't return. And this year, they're already starting to talk about the debt ceiling in the summer. That would be probably a similar catalyst to Nixon resigns in that summer. And so I don't think the market's necessarily out of the woods yet for the longer term, but short term, it could work out okay. So as I said, if you visit that URL, you'll be able to download the PDFs of this seminar and also take advantage of those offers. If you're interested in our money management, we have a slightly different website, McMillanAsset.com. So Rob, I'm just about exactly on time, I think, and let me turn it back to you.
Well, Larry, you hit it right on the head. Amazing. And as usual, incredibly informative information. I have to admit, Larry, listening to you speak, I can't imagine how brilliant you have to be. I'm sure in person it would just be, oh my God.
Thank you.
Ladies and gentlemen, that was Mr. Lawrence McMillan of the McMillan Analysis Group. We refer to him on Traders Corner as the E.F. Hutton of options traders because when he is talking options, it is a real good idea to listen. I guarantee that you will learn something. And the first time Larry presented for me, it was about the put to call ratio, market breadth, stuff like that. But keep up the great work, Larry. I waited all day to listen to your perspective on the current environment. Would you please come back and see us again?
Sure will. Yep.
Ladies and gentlemen, you can find Larry at www.optionstrategist.com.